In this video, I'm going to talk about the noisy non-farm payroll strategy. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this strategy can be used during non-farm payrolls, during interest rate announcements, during anything that comes out that's expecting to move a currency pair or an index. So, you know, those kind of things, economic indicators, anything like that. Non-farm payrolls, that jobs number that comes out in the US is a big one. Interest rate announcement, another one. Now, we all know that these are the kind of things that can shift markets dramatically. If there's a surprise announcement, you can get 100, 200, 300 pips move on the currency pairs. You know, massive movements on Dow, Nasdaq, S&P, DAX, whatever it may be. It can move the markets. However, very often you get people pulling liquidity from the underlying market, and that causes these kind of ping pongs back and forth. You know, it pings up, pings down, and just settles in a trend or goes back to do exactly what it was doing. So the idea of this strategy and this setup is that you look to take advantage of that and look to fade the move. Now, it sounds more dangerous than it is. I'm going to quantify it very, very clearly. The stops are very defined on this. There's no room for ambiguity. And as always with these things, it's not a recommendation to trade, just purely an observation. And, you know, you should be managing your risk if you are trading out there. So how do we do this? The first thing first is that this strategy will protect you somewhat. You never get protected. You've got to manage your risk separately from this, but the entry criteria won't get you in and then have it just rip off to 300 points against you. Okay, possibly could, but it's not going to be ones where, let's say, something surprise comes out and reprices something 300 pips immediately. That will not trigger an entry into this strategy. You could still get in at some point, but let's look at the rules anyway. Easy to show you guys the rules. So what I'm using is a Fibonacci retracement. I've got on here US dollar JPY 5-minute chart. And this was over the non-farm payroll data that recently came out. I've used this strategy for a long period of time. I know that it's an effective strategy, so we can use it on any kind of data. So the idea of what we're doing is that we are saying, okay, we want to see a move in one direction, and we want to get on a reversal of some point and trade that in the direction of reversal for it to come all the way back. So if that's the impulse move one there, we want to wait for that to end. We don't know how far that's going to go, but when it starts to reverse, we want to get on the reversal and trade the short side of that, or if we're doing the other way around, the long side of that. So we're trading the back end of the move. So this is the initial move off that non-farm payroll figure. I've got it on a 5-minute chart. You can go down to 1 minute to be a bit more granular of course, but this is fine. So fib, I'm going to just put the top of that bar there, if I can just about tag it, and the lower bar there. Now don't worry if this is drawn the wrong way round or it's not quite the same. Don't worry about it, because, you know, each of these bands is the same width. It's just a number that's different. So it's the same width. So 50% is the same. 61.8. It's either 61.8 off the high, or if you flipped it round, you know, it would be saying 38.2% from the 100. So whichever way you do it, it's the same. We're just looking at the distance between the two kind of bands here. So the strategy criteria are this. As we get an impulse in one direction, we draw our fib and we put a high and low. Normally the first 5-minute bar. Could be 3 minute, but normally about a 5-minute bar, you're good to go on that one. High and low, bracket it with our fib. Now what we look to do is, as the price comes back above the 50, in this case above the 50, we look to go long as it crosses the 0.618, or if you've got it flip reverse, the 0.382. So it's this little band here, if you like, and whichever way you're looking at, it's that little band there that you're looking for. You're looking for it to cross through that band, through the 50, through the 6.8, and the stop is going to be below the 50. Okay, so we're long here. I can't quite draw it on that. Let me just get my pen out. So we're long here. Our stop is here. And our target's generally going to be at least some off as we take out the high, at least some off. Now, of course, if you think you're on the end of a longer move, by all means hold it. This could be a precursor for a long move. And often I've seen countless times I was whipping one direction, back the other, and then just rip off into the sunset or into the depths of hell, however you want to look at it. Same with the Euro US dollar. Look, same kind of thing here. I've got my Fibonacci retracement. I'm going to do the top. I'm going to do the high and the low. I'm going to bracket it. And again, don't worry about whether you've got it the right way around or not. All you're doing is kind of framing this structure here. We're going short as we come back down to the 50, so the impulse move is to the upside, so we can go short. We don't know how far this bar is going to go, guys. It could go on forever. Obviously not forever, but you get the idea. It could go on and on and on. We just keep stretching the fib, stretching the fib, stretching the fib. When it starts to come back down, we know we're going to go short as we come through that 0.5 level, which is going to be here. So around here we're going short. Our stop is going to be, we're going to go short as it comes through the 0.618 level, and our stop is going to be at the 0.5. So we're short here, holding it, and we get our first target here. And again, we can hold it and trail it, and I think that's a good thing to do, at least hold a trailer. So you know that your risk is quantified. Now, these two examples, I appreciate that the moves on this at the moment is not that much meat on the bone with these trades at the moment in time. You're talking very tight stops, and in fact you might want to go wider and kind of use a minimum of 10 pips or something like that, or whatever. I mean, you can adjust and play around with it. However, when we start getting really kicking off and we get 100-point moves swinging, it's quite volatile and wild, then there's a bit more meat on the bone. However, obviously the stops shrink as the targets shrink as well. So if you've only got a 20 pip target, your stop's going to be shrunk down as well. If you're 30 pip target, it's going to be slightly wider. So that's the beauty of using this fib. It kind of adjusts your stop for the volatility and the aggressive nature of the move. Have I got one more to show you guys? Yeah, let's have a look at the S&P 500 here. Again, not much of a move going on, I will give you that, but same kind of strategy. We're looking to go short as it comes down through that 618. So its impulse move is up. There's the high, there's the low. Short through a 618, stop at the half, and we're going to end up breaking the low. So very structured, very simple strategy. Something you can perhaps add to and work on. But just remember, you're putting your highs and lows. You're using that 50, and you're using the kind of the two either side of it, whether it's the 618 or the 382 as your entry, and you're using the 50 as the stop, depending on whether you've gone high or low. Pretty simple. Pretty kind of useful. As again, be very careful trading around any news, because it can be exceedingly volatile, and if you've got something when news is coming out and there's a press conference later, you can have a second kind of wave. So again, not recommendation to trade, but just an observation, something that I think is interesting to look at further. But if you keep the risk managed, it's a kind of strategy that can work very well. Anyway, guys, that's it. If you like the video, give it a thumbs up. Don't forget to leave your comments in the comment section below, and as always, have a good trading week, month, year, wherever you are, and of course manage your risk, and I'll see you in the next one. Bye bye.